do see this red button that I'm supposed to see.
There you go. We're ready.
And welcome to another edition of Abundant Retirement with Tony Roberts. I am your host today for this podcast. And as always, I'm privileged to have Mr. Tony Shore with me to give me guidance, direction, and to keep me on track because as many of you all know, I can get off track every now and then when we start talking about things. So, hello, Mr. Tony Shore. How you doing today, brother?
Well, I'll try to keep you on track, Tony, but I don't know. That's a big ask, and I myself, I might sidetrack us. We'll either be talking about pizza or music if I
Hey,
get
hey,
sidetracked.
it's March Madness, man. I mean,
Yeah.
it's time to start filling the brackets out and figuring out. I saw today if you have a perfect bracket, you can maybe win a trip to Mars or something like that. I don't know.
I
It's
don't
pretty
think
crazy, isn't it?
I don't want to go to Mars. Just give me the money. Show me the money. Uh,
Yo, I guess I don't know. Maybe I've never been blessed to have that much wealth to where I can just sit there and say, here's $1 billion. Let's go to Mars. I don't know.
yeah,
It seems
crazy.
like to me there'd be some things that you'd be doing better with $1 billion and heading out to Mars.
I think so, but yeah, I mean, I've heard the argument that hey, space exploration leads to newer inventions and improving our way of life, but back in the day, that might be the case. I mean, what did it give us? Tang and ballpoint pens? I don't know, but 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 I don't know,
You're
man.
showing your age there, Tony.
Mars isn't
Dang, that goes back a long way, brother.
Mars isn't Mars isn't livable. It's not like a vacation spot. It's not like going to Key West. You know what I mean? so
Although there may be some things down at Key West that resemble Mars. I don't know.
now there you have a good point. Yeah, there's some alien life down there. I'll tell you
Oh
that.
my gosh.
You
Oh
might
my
feel like
gosh.
you're on another planet in Key West. It's a crazy place.
Yeah.
But Tony, I know we don't want to get sidetracked, which is exactly what I did. I've had a great week. I know you've been busy meeting with clients. I think that's great. But today, I love the topic you came up with for your show today. And this is something you deal with on a daily basis with your clients and people you talk to. So our listeners and viewers out there will probably get a lot out of this one because we're talking about the importance of diversification
Yeah.
with your portfolio, especially when it comes to planning for retirement, right?
Correct. Yeah. Yeah. It's very important. And I get this a lot, Tony, because, um, people sometimes, say, Tony said, what exactly are you talking about when you talk about diversification? And basically, Tony, the bottom line definition of diversification, is spreading risk across different asset classes and different things like this. And unfortunately, we're all sort of caught in a catch 21, so to speak, with our 401k plans, our 403bs, our federal employees with their TSPs, into the fact that when you are investing in these employer retirement plans, for the most part, you only have, you can say maybe two, but for one, if you want to have earnings and growth, you pretty much have to invest in whatever options they give you to invest in. And for the most part, that's 100% being in the market. And again, if for my daughter's ages, or if you're in your 30s or 40s or possibly early 50s, and you're still 10 years out or more till retirement, probably having all of your money working in the market is a good thing. However, the closer you get to retirement, the more you want to start to safeguard your assets and your wealth. And a lot of times when people are sitting there saying, hey, look, when I enter into retirement, do I still want to have the same type of risk portfolio, so to speak, and taking the same amount of risk and having my money just, work solely in the market, or do I want to diversify myself such that, again, over, I think Mike Binger in last week's podcast summed it up, very easily from a standpoint that said, hey, look, when you look at the market every 4 to 5 years, we're going to have 1 year that's going to be a downturn. Well, Tony, when we're working, maybe we can take advantage of that downturn. If the market's down and we're investing, we're buying bigger units, bigger chunks, When the market comes back, that's all good and dandy. But when we're upon the precipice of retirement, or we're actually in retirement, and that market takes a downturn, and if I'm needing that portfolio to provide me an income stream to allow me to live the lifestyle I want to live in retirement, sometimes that snowball might become an avalanche. So again,
Yeah.
having yourself properly diversified, looking at what we call green money, to where that might be in government bonds or CDs or fixed or indexed annuities, possibly cash value life insurance. Different things like that can give you a better and a more proper diversity, such that when we do have downturns in the market, it doesn't affect your overall portfolio as greatly or as severely as having, for lack of a better word, all your eggs in one basket.
Yeah. Well, and what it does is when we're in times of market volatility, like we are right now, the markets have been very volatile this year so far. Then, if you're in retirement and you're working with someone like yourself, a trusted professional who has that diversification, then you're not worried. Okay, the market's down, but I know I'm taken care of. We've planned for this, but it helps you sleep well at night. Otherwise, if you've got all your money in the market, it's all at risk, and you haven't done any changes, you're not working with a professional, or you're trying to do it yourself. When the market's down, you're going to be panicked, and you need to pull out every money out of that market while it's down. You're pulling money out every month during the down years too. You're going to deplete, even if you've saved a lot for retirement. It can go fast if you do that. So you can't do that. You have to work with a professional. I'm not going to name names, Anthony Roberts, but I know a guy, Tony. I know a guy that can help, and that's why we're talking about this today, right? I mean, and it's timely. I mean, there's always market volatility. Usually, I mean, we had 2 huge up years. But right now, there's a lot of volatility, and the reason your clients aren't panicked is because you have a plan in place, right?
Exactly right. And again, just to give you, I mean, this is in live, what's happening right now with some of our clients. But last week I was meeting with some clients, and both retired. We're looking for income streams coming from their wealth to accompany pensions and social security and things of that nature right there. And what we did just recently is we went in and turned down the faucet on their investment portfolio as far as it providing income, and we went over to our green money. And in this case, it was a fixed index annuities is what they had in place, but we went over to the annuity and we turned on the income to come from the annuity. Now, why is that important? Well, number one, the managed money has taken a bit of a hit this year, just like what you were talking about. So the last thing we want to have happening is having the pressure of a market downturn and also providing income stream. It's sort of like we're double dipping in a bad solution right there. So
Right.
again, we want to give those portfolios time to recover, which they will. But in the meantime, our clients need to still have income. So again, we went over to the annuities, and even though the annuities are linked to the market, by definition of the annuity contract, if the
Mhm.
markets go down, you just simply get a 0% return. So we went over and turned the income stream up on the annuity contracts, turned it down on the managed money contracts, and we're going to play in that arena for the next 4 6 months, see what happens with how
Yeah.
everything comes back and repositions itself and things of that nature right
At
there.
least
So
at least your principal's protected, and you're not selling stocks when they're down and then
it,
ending up buying when they're high. I mean, that's the opposite of what you wanna do. You don't wanna be pulling money out of the market when it's down, and that's what the majority of investors end up doing, that, at least the do-it-yourselfers, because, they
Well, they
panic.
they panic. They
Yeah,
panic, Tony. And again, it's we feel calls all the time of, oh, my portfolio's down. Or I had this call the other day from a client who called, and she's actually 7 years away from retirement, and we've got her. She's a government employee, and
sure.
she's in the C fund, which is basically the TSP's S&P 500 fund.
Right.
And she said, Tony, my portfolio is down $12,000 in the last week. Should I take it to G, which is the more protected, less volatile option in the TSP? And I just looked at her and I said, look, you're 7 years away from retirement. If you get out of C right now and go to G, you're locking in a $12,000 loss.
Yeah.
You don't need to do that. You
No.
don't need the money now. You don't need the money next month. You don't need the money 6 months from now. We're looking at a long-term play for you that's 7 years down the road. And so I said, just don't panic. But again, she has the luxury of still being working and things like that. When we set up proper retirement plans and holistic retirement plans for our people that are actually going into retirement or already in retirement, we look and know that balanced portfolios tend to perform better over time. There's different asset classes respond differently to different economic conditions. Uh, there's just different things that go on. Stock market fluctuations are going to happen no matter what. Economic downturns are going to happen. So again, you have to understand how you've got your money positioned, how you've got it set up so that it's going to react the right way when the markets are up, but it's also going to give us a layer of protection when the markets adjust downward. And again, how does that alleviate or work hand in hand with making sure that you have the income needs met, month in, month out, year over year, and different things of that nature right there.
Yeah. Yeah, and I like what you said. I mean, balanced portfolios do tend to perform better over time. Different asset classes respond differently. And you want to have those compounded benefits too. I think that's really good. Now, what about protecting against market cycles? I mean, like you said, the market goes through cycles. We had 2 huge up years and actually abnormally up. I mean, 2 years where it's way over 20% each year. People got spoiled because the market just kept going up and up and up, and there were to not have a correction. Sometimes there's 2-3 corrections a year where you have a 10% drop. For 2 years there, we didn't have that. So people are panicking because now there was a drop. But they're still up. If you look at last year, the Dow, even though it's down this year, you're still up with gains from last year, right?
Well, yeah, we are, but again, Tony, let's take it back another year. Let's go back to 22.
Oh,
Let's look
yeah.
at we came off of 20, which was COVID year, and
Yeah.
Lord knows the first quarter of 20 during COVID, we had no clue where the market was going to end up. Well,
Yeah.
by the end of 20, we are actually at all-time highs. 21 was actually a very good year in the market, and
Yep.
then guess what happened in 22? The market took its downturn. And
Yep.
again, Tony, why does the market take a downturn? A lot of times it may be because companies aren't meeting their top and bottom lines, but other things happen is this. Sometimes these brokerage houses and investment banks want to take profit. And I know we've talked about this before, but just like playing blackjack, you may have a stack of chips in front of you that's piled 10 inches high, but until you push them into the center and tell the dealer you want to cash in, there's no profit in your pocket.
Right.
The same thing is true with stocks.
Yep.
These investment bankers, these brokerage organizations, the people on Wall Street and this, that, and the other, occasionally they'll sit there and say, hey, look, Apple's at an all-time high, Nvidia's at an all-time high, whatever the case may be. They basically say, hey, look, let's push some of the chips into the middle and take some profit. Well, the only way you can take profit is to sell.
Yeah.
And when you sell, the market is going to reflect and go downward. So again, in 22, the market's dependent on where you were at, but it could be anywhere from like 16, 17% up to almost 30% is what some of the indexes were down in 22. Well, guess what? In 23, made all of it back.
Yep.
And then, like you said, last year, we were already made it back, and then we climbed up another 20 to 25% ladder.
Yeah. Crazy.
And we're up on high. So now, we're sitting here this year, and if we're down 5 to 10% or whatever the case may be, looking at this thing over the last 5 years, we're still significantly up on the managed money side. But again, properly diversifying yourself so that you You can avoid the panic selling that
Yeah.
again I just alluded to. The one client who called me up. Uh, Disciplined long-term investment strategies usually outperform people
Yeah.
trying to day trade or time the market. So again, looking at these things, making sure you've got broad exposure, making sure you've got the ability to meet the income needs you have to meet, those are all part of being properly diversified. And even with the managed money side of it, Tony, there are ways that you can go in and protect yourself with lesser degrees of risk. Active portfolio management and things like that are things that we have the ability to offer and to perform with that, again, help overall diversification, overall lineup of what your wealth is doing for you and trying to do for yourself very, very well. Some people need more income than others. Some people want to grow. Again, everybody's different, but being properly diversified with the types of income and wealth structures in place make a lot of sense for most people.
Well, and Tony, I know you've talked a lot about in the past, and I've heard you talk about risk tolerance and the time horizon, and you base a lot of where the money is at and how much is in the market versus other areas based on someone's risk tolerance and their time horizon, right? That really changes it, and everybody is different, right?
Oh, most definitely. Everyone is different and everything else. And Tony, something we pride ourselves in at the firm is we try to use all the tools in the toolbox. I mean, I know there's some outfits out there, and you see them advertised on TV on a daily basis. You've got people that are on the radio on a daily basis that are preaching different concepts and different types of strategies and everything like this. And if you're not 100% in the market, you're losing out in this, that, and the other. We don't take that position. We look and say, hey, look, what makes sense for you? Does having a proper, again, actively managed portfolio make sense? In most cases it does, but does that mean you want to have 70, 80, 90, 100% of your wealth in a managed money portfolio? Probably not. Again, that brings that diversification into play. And so we look at and say, hey, look, is it a bond? Is it a CD? Is it an annuity? You know, do you have a need for life insurance, or especially these hybrid life insurance plans, with the long-term care provision that a lot of people are attracted to? So again, when we look at all of these different pieces, my job as an advisor and as a fiduciary, Tony, is to put on the table different ideas, different concepts for my clients to consider, see if there's interest, and then let's have a discussion and a conversation about those concepts and strategies and ideas that are resonating, and see if they make sense or not. And then if they do make sense, then maybe we then bring other specialists of the client into play, whether it be their CPA, their tax attorney, whatever the case may be, to make sure that at the end we have got a well-rounded, diversified portfolio that is going to provide income as needed, increase year over year, maintain and grow the wealth, lower their risk profile if that's what they want to do, and then also be able to sit there and say, hey, look, we've got to be able to plan for future inflation because it's gonna happen.
Yep.
And I really think this thing's, Tony, going to land probably when the dust settles year over year, probably somewhere around 4% instead of the 2% that Jay Powell wants to get down to. But at 4% inflation, Tony, that means our costs are doubling every 18 years in retirement. So if I retire at 60, I've got to make twice as much money by the time I'm age 78 just to be equal to where I am today. So again, how are we going to work with inflation? How are we going to have a conversation about tax? I've said this many, many times, Tony. I'm not a CPA. I'm not a tax attorney. But I know of 7 or 8 different tax strategies that are part of the tax code that can possibly save you money. And because I own my own firm and I'm my chief compliance officer, I'm allowed to talk to my clients about what I want to talk to them about. Now, the big brokerage houses, some of the firms that are down the street from me, and I don't have to name their names, but they direct their advisors from high that says, hey, look, you can't talk to your clients about tax planning. Well, Tony, it's the biggest hand in our pocket in retirement. What
Yeah, it's
good
one
am
of the
I as an
biggest costs.
advisor? And why
Yeah,
are you paying me a fee if I can't talk to you about tax planning and
right,
at least give you some ideas that we can go back to your CPA and talk about and do everything else like that? So
right.
again, taxes and your legacy planning and long-term care, and do you have your
Healthcare.
legal piece in place? All of these things are very important when you're looking at the overall diversification of your wealth, of your planning, what you're trying to accomplish as we go into retirement, or maybe as we continue with retirement, in putting these pieces together.
Yeah. And don't make emotional decisions with your portfolios or with your investments or with your retirement funds. Make sure you're working closely with someone like yourself, because you can take that element out of it. You're going to look at it in a professional manner, and you're looking at the big picture, not just responding to something that's happening right now in the market that will be, over with possibly tomorrow. So I know you look at the big picture, and I think that's fantastic. Before we go, make sure you let our listeners know, Tony, I know you're offering a no charge, no obligation consultation, correct?
Yeah, what we do, Tony, is actually you're probably going to get a couple of meetings with me.
Hmm.
And for anybody that listens to the podcast or calls in and says, "Hey, look, I heard, I heard one of your podcasts, and you made this offer," or, Tony, we have this happen a lot. People will call in and just say, "Hey, look, I'm already retired. I thought I already had a plan in place, but I may need to get a second set of eyeballs to take a look at it." Whatever the case may be, you're going to get a couple of meetings with me, no charge. We're going to take a look at where you are, where you're trying to get a better idea of what your visions and your ultimate goals are that you're trying to reach, and see if there's a better way to go about doing it. And if there's not, we'll tell you so. But in all likelihood, I would say we're going to probably uncover 3 or 4 things that could maybe save you money, make you money, and do some of these things that a lot of people become very, uh, you know, antsy, or maybe, like you said earlier, lose that sleep at night because you're
Yeah.
waking up at 4 o'clock in the morning, and that's usually not a good sign, from that standpoint there. So yeah, you can reach out to us several different ways, but probably the easiest, you can go to our website, arobertsassociates.com. And there's a link there that you can reach out to get an appointment with us. You can call us direct here at the office, 888-955-3665. Again, that's 888-955-3665. And get with one of our staff members, and they've got my calendar. We'll set up that initial meeting, probably 40-45 minutes, get to know each other a little bit better. And then if you want, we'll collect some data, run a few reports. That usually takes us 7 to 10 days, a couple of weeks. And then we'll circle back for that second meeting and give you the results of those reports and see if there's some places there that we feel like you might be falling short, that we might be able to help you out with, to make things look a little bit better for you.
Fantastic. Well, Tony, great show today. And listeners, I'm sure you have questions. So once again, Tony's offering that no charge, no obligation consultation, and the number is 888-955-3665. Or you can check out the website at arobertsassociates.com. That's arobertsassociates.com. Well, Tony, great show today. Listeners and viewers, thanks for tuning in. That does it for today's episode of Abundant Retirement with our host, Tony Roberts.
Thanks, Tony.